Good afternoon, everybody. Thanks for joining us here for another episode of U.S. Home Talk. We are your mortgage and real estate podcast made by the people for the people. I'll be your host today, Mike Overson with Luminate Bank here in studio. And on the show with me today is Mark Grave with the South Dakota Home Team, powered by Hague Realtors. We have Jason Walgrave with Walgrave Real Estate Group, Remax Advantage Plus. And we're going to talk about some mortgage rates today. So that is the topic that has been somewhat hot lately. If we rewind back a few weeks, Trump came out and said that he wants Fannie and Freddie to buy up some mortgage-backed securities to the tune of $200 billion. And that created a lot of stir because a lot of us in the industry know what type of impact that could have on interest rates. But has that impact hit yet? How much of an impact is it going to make? What are we going to see for interest rates coming down the pipeline? That is our conversation for today. Mm-hmm. Okay. Mm-hmm. So other economic factors too. So there was a jobs report recently that came out that was really good. That actually does not help interest rates. Okay. So
this report did.
This report definitely did not. And just in general, if we just talk about mortgage rates, right? In general, if it's good for the economy, it's typically bad for mortgage rates, meaning mortgage rates will go up from it. So just keep that in mind. That's the way it works. So you see a good jobs report come out. Typically, that means it's going to impact interest rates negatively. Now, are we talking like one single jobs report comes out and rates go up 0.5% from that one report? No. Right. We're not talking about that type of swing, right? Maybe they go up 1/8 that day because of the jobs report. 1/4 at the absolute most, but that would even be like a big jump from something like that. So don't let that news around that stuff kind of like freak you out or think like, hey, great jobs report came out, rates are going to drop out of the bottom. Doesn't work that way. Okay. But the bigger thing that I want to talk about is what are we going to see for interest rates moving forward through this year, right? So I want to kind of recap of what happened in 2025. Okay. I consider the interest rate market in 2025 kind of like how we see March in Minnesota and South Dakota, in like a lion, out like a lamb, right? Isn't that the old saying for March? Okay.
Yep.
So if we look at the first quarter to first half of 2025, our rates were bouncing around a little bit. We saw rates up in the low 7s. We saw rates down around 6%, but they weren't consistent. They were moving around and stuff, right? We were all talking about back then of how we want to just, if you could just give us a consistent interest rate, somewhere in the 6s, we'd be happy. Something that's consistent, something that's predictable, right? Yep. So that when we have buyers and we're out looking at homes, it's like, hey, your payment on this $400,000 house is going to be X today. In 2 weeks when rates go up 1%, right? Now that changes your payment drastically. Now you might have to look at it. You might have to change your search criteria, right? And then 4 weeks after that, they go back down and it's like, okay, so now we can go back up to that other price point we were looking at before. And it was just kind of weird how things were bouncing around. The back half of 2025 was nice. Consistent, 6.5%. Wasn't moving much. We just got that nice consistency. And then over the fall and through the winter, rates kind of just slowly came down. And now we're hovering right around that 6% mark. And we've been there for a couple months.
Yeah, I think that the irregular rates up and down, it causes stress on buyers specifically and sellers too. But I mean, 1%
and loan officers
and loan officers and real estate agents, right?
And real estate agents, yeah.
But it's like 1%. What does that mean? Okay, so if you're approved in today's world, today's interest rates, and you're approved for $500,000. If those rates go up 1%, it decreases your buying power by 10%. Now you're only qualified for a 450 house, and that could be a whole different neighborhood. It could be a whole different area, right? And so 1% makes a 10% difference in your buying power. So that doesn't create a whole lot of stability in your mind, right? You're not very confident if you're out looking at houses and then you find the one you want and all of a sudden rates pop up and you're like, can't buy it anymore. That's not good.
Yeah. And we saw that towards the beginning of 2025. And like I was saying, like towards the end, the back half of 2025, we saw that stability come in, which was a breath of fresh air for all of us. And I'm sure you guys can tell, I mean, or you'll be able to see that the fall of 2025, I mean, given the circumstances, was actually nice.
Yep.
Because of that predictability and stability. Yep. Go ahead, Marcus.
Yeah, I was just gonna say, I mean, that's something where, you know, Jason and I, we had these conversations with prospecting buyers, and Mike, if you speak to them, you know, directly via the first point of contact, it's that, you know, you have to have the conversation with your mortgage banker and find out what you qualify for, because probably the worst thing you can do is to start looking at homes without knowing what you can buy. You fall in love with one, and then you finally say, okay, well, I'm ready to reach out to Mike, and you reach out to Mike, and Mike says, you know, all right, good, got great news for you. You know, qualified you for 600. It's like, well, God, we fell in love with the 650 this past weekend. You got 50 grand cash because you're gonna have to cover the difference because I qualified you for 600. So I mean that's that same feeling. You know, where if that rate were to raise to not in your favor, and then you lose that 10% purchasing power, it's kind of a heartbreaker. You're like, man, we saw some nice ones that we really liked the amenities, and now we just found out that we got to drop at 50 grand, and then you look at those and you're like, holy buckets, I'm missing you know, that third stall or that main floor laundry amenity that meant a lot, but we had to go up a little bit higher. So, you know, the stability is huge for the buyers out there.
Yeah, and I think I think moving forward here, I think we're gonna continue to see that stability. I don't see anything that's really gonna make interest rates bounce around. If anything does happen for interest rates where they move a decent amount, it's going to be this purchasing of the $200 billion in mortgage-backed securities.
Right.
That is an artificial way that the government can step in, right, and lower interest rates. It's called quantitative easing. They did it for years, from like 2012, 2013, all the way to like 2018, I think, or 2019, something like that. And it's just, again, it's basically all they're doing. It's kind of like a supply and demand. What they're doing is they're pumping $200 billion worth of liquidity into the mortgage market, right? So you're increasing the supply of money. So when you increase the supply of something, what happens to the cost of that something? Goes down, right? As the supply goes up, the cost goes down because there's more of it there, right? And so that's what they're really doing. They're pumping money into the mortgage-backed securities market. That's putting liquidity into the mortgage market. That's going to artificially bring rates down. Now, how far down could they go? Great question.
Hey, you know, it was a great question, right, Mike? And we had the Yoda on a couple shows ago, and we were discussing that, and he used the reference of, you know, there was at one time, you know, there was $120 billion every month that was going into it, and to get the rates down. You know, this is one. It hasn't happened. It's you know, Trump wants it to happen, and
Right.
two, it sounds like it's just going to be a one-time thing, right? And so, you know, are we going to see a point drop? You know, a full 1% drop? No, you know, that's not going to happen. I mean, I think he threw out there, you know, maybe a quarter. You know, most likely, it'll bring it down an eighth and keep it down. You know, not being that reactional drop, but it'll bring it an eighth and it'll keep it down an eighth.
So, yeah, I would agree. I think it's going to be a one-time event. I mean, $200 billion, it's a lot of money. Don't get me wrong. That's a lot of money. But
To us,
it's a lot of money, right? But if you look at what they've done in the past, like Marcus's point, $140 billion a month after month after month after month, right? Several months in a row. I mean, that's way more money than the $200 billion in a one-time shot we're going to get now, is what it sounds like it's going to happen. But that's the other thing, is how is it going to be implemented? Is it going to be $50 billion a month for 4 months? Is it going to be a one-time shot?
Good point.
Yep.
You know what I mean?
Great point.
Good point.
That's the other thing too. But I don't see rates just dropping out of the bottom. I don't see that 1% drop from this. It's going to take way more money to pump into the market than $200 billion to drop it a full percent. But I do think that people are out there are thinking that that's what's going to happen. And I don't want to burst your bubble. I mean, I don't have a crystal ball. I can't predict the future, but just what I know from the past, the dollars that were spent on this same scheme, if you will, I don't know, whatever you call it, I just don't see him moving a crazy amount. So I think 0.25% would probably be reasonable. Yeah. So, but
It's going to help with the stability. Like you said earlier in the show, a really good jobs report means that economy is looking positive, and usually that means that there might be a chance that the mortgage rates are probably going to move up a little bit. It's like, well, maybe that can kind of counterbalance that, and we just continue to hammer out this 6.8, 6.25, for the next 9-12 months. That keeping that stability, I think, is going to be the most important thing, the key thing, because buyers are happy if we can get them a 6 or a 6.125. They're pretty excited about that. It makes sense. It's the numbers you were running for them, 2, 3, 4 months ago.
Mm-hmm.
Right. Exactly. And I think Trump is smart by doing this, by not putting too much money in there. And I'm going to explain why, but we're going to do a legal minute first. I'm going to come back and I'll tell you my thoughts on why I think it's a smart move.
This is Jeff O'Brien, attorney with Hush Blackwell with the U.S. Home Talk Legal Minute. What does Minnesota's legalization of medical marijuana have to do with real estate? Plenty. That's because until recently, real estate which is used in the manufacture of a controlled substance such as marijuana could be seized by the federal government. Despite various states' legalization of the drug, marijuana remains illegal under federal law, and under the doctrine of preemption, the federal criminal law would trump state laws that otherwise permit the manufacture, sale, and or use of marijuana. However, the recent spending agreement between the U.S. House, U.S. Senate, and the President codified a policy of the U.S. Department of Justice that directs U.S. attorneys to focus law enforcement efforts regarding marijuana in states which have legalized the drug to some extent towards areas that remain illegal under those states' laws. This issue of federal preemption is an important one for property owners, not just for criminal reasons, but also has an effect on lease and banking covenants and insurance covenants, hence the urgent need for legislative action. If you are a property owner whose property is involved with the manufacture, use, or sale of medical marijuana under Minnesota's new law, be sure to consult an attorney knowledgeable on these issues. This is Jeff O'Brien, attorney with Hush Blackwell with the U.S. Home Talk Legal Minute.
Thank you, Jeff O'Brien.
Thank you, Jeff.
Always filling us with knowledge there with the legal aspect in real estate. So getting back to my point here, why I think not pumping too much money into the mortgage-backed securities market is a good idea. I'm going to ask you guys a question, okay? What happens if, let's say we're at 6% today in interest rate. What happens if we get to September, October, and rates are at 4.5?
Oh, well, you're going to be busy.
I mean, true.
I mean, the refi is you won't be able to sleep. Just work through the night. I mean, it would be incredibly competitive in the purchase, the buying market for real estate. I don't think there's any way I don't think we'll ever see 4s again. But it would be.
But let's say it happened. What does it do for buyers? What does it do for sellers if we and that would be almost overnight, going 6% down to 4.5, like that quickly, right? What would that do to buyers and sellers out there?
A ton of multiple offers, incredibly competitive. Sorry, Marcus. So it's great for sellers because it's going to drive the prices up. But a lot of those sellers are probably buying. So it depends if they're buying up or buying down, how that affects them. I mean, it's, part of me is like, oh, that'd be fantastic. We'd be so busy and we'd be able to help so many people, but it's not really a great event if that happened, because everyone's running around with their heads cut off and decisions are having to be made, like this. And so I don't think it's fantastic overall for the real estate market. But I'd love to see 5.5s.
What do you think, Marcus?
I would agree. I don't think I can confidently say that it would not be overall a good event, because we have this affordability crisis right now with housing to purchase a home. If that were to happen, to Jason's point, every buyer is going to want to get into the market. Every buyer is going to try to buy a house. They're going to be fighting with each other because our inventory is super low. That's going to drive the home prices up, like it did in the early 2020s. Home values are going to shoot up, to even a more affordable price. So that's probably the big negative to it. The only positive I can think of is that you have a large group of homeowners that own their house and they're sitting on a 3.5. And if they saw a 4.5, then they'd say, okay, I'll sell this bad boy. I'm gonna kill it. I'm gonna make tons of money.
Yep.
And I don't really care that I'm gonna have to take it and get beat up on the purchase because I'm gonna crush it on the sale. And that 4.5 sounds good too. So, that inventory, that pre-existing inventory, I do think we would see in a great increase in that specific sector for housing, which is what we really need. We need more pre-existing homes to hit the market. And one of the reasons why it's not is because a lot of the owners are sitting on a pretty sweet rate. So that's probably the only silver lining I can think of. But first-time home buyers, first-time move-up buyers. First-time home buyers. They're already getting beat up, but they'd be just simply removed from the equation. There wouldn't be a property for them to purchase. It wouldn't exist.
Yeah. Our first-time home buyer average age right now is like, what, 40 years old?
42, I think. Isn't that what it was? The NER came out and said 42 is what it was at the end of 2025?
Yeah. Rates dropping to 4.5 that quickly or something would probably push that first-time home buyer age to like 45, 46, 47, which is unheard of. That's unreal.
Yeah.
To have your first-time home buyer age to be that age, you know what I mean? But it's all about the affordability, and it's like, well, everyone's like, well, 4.5%, that's going to offset your payment. That's going to bring your payment down. Yeah, but you kind of eat up that savings by paying 30, 40, 50 grand more for the house because you're competing against 22 other people. Yep. You got to outbid 22 other people for this house that you want to buy, in the bread and butter price point. Yep. And it's like, great, you're at 4.5, but you just lost all your savings because you got to pay 40 grand more to get it.
Yeah. And the first time home buyers they're staying in their homes the least amount of time, so it isn't like you're, okay, I'm buying this house and I'm going to be there for the next 15 years. I can justify paying more. Time can offset paying more, but if you're only going to be there for 3 to 5 years because you're going to outgrow the house or job transfer, whatever the case is, very hard to make up that, overpaying for a home if you're only going to be there for a short time. So, I think for the most part it would not be a fantastic deal, and for most, and but again, 5.5.
But again, I'm just saying
that'd be a great
5.5
rate,
seems
right?
to be. Jason is like, but just by the way, 5.5 seems to be pretty much.
I'm trying to will it. into truth. 5.5.
Trump, if you're listening out there, right? Real estate market people on Wall Street, if you're listening out there, just get us to 5.5 and hold it. 5.5.
5.5.
I think that's fair. 5.5 is affordable on the interest rate side of things. It gives equal opportunity to buyers and sellers, where it's like, okay, buyers can get a little, breath of fresh air from a slightly lower interest rate, having lower payments. It's not going to cause home values just to go skyrocket and go crazy, right? It's not going to be this landslide one way or the other where it's heavy seller side, heavy buyer side. I do think that 5.5 mark, and that's probably why I think Trump is like smart by not putting too much money in here, dropping rates too fast. He probably sees the same thing. Yeah. He's probably saying, look, if this goes too low too quickly, that's going to be bad.
Yep.
Right. We just need to bring this thing down a little bit, right? Put a little Band-Aid on this wound, right? A little bit of Neosporin, right? Let's get it under control here and let it sit for a while. And let's kind of let it heal on its own.
Yep. Rub some dirt in it.
Spit on it, rub some dirt on it, get back in the game. That's right. Well, appreciate everyone joining us today. Thanks for listening to this episode of US Home Talk. Visit us online, ushometalk.com. That's the best way to get links to our past shows. You can connect with us through ushometalk.com as well. So on behalf of Marcus Walgrave and Jason Walgrave, I'm Mike Overson. Thanks for joining us. We'll see you next week.